Welcome back, everyone, to the Informed Home Buyer Podcast. I'm your host, Rich Curtis, and I've got my co-host here, Dave Miller. Welcome back, Dave.
Hey, Rich. Thanks for having me.
All right, so for today's episode, we want to talk to those of you who have been thinking about buying another home and have been reticent to do so because you've got that wonderful pandemic era interest rate and you're out shopping and you just don't know if you're willing to take that plunge and take on that bigger rate. We're going to talk about the concept of converting your original home to a rental as a offset to your new mortgage payments and having two homes appreciating for your long-term wealth building. Now, I will say from the top, we're not financial advisors. This is not financial advice. This is just a scenario for you to consider if you want to take advantage of the fact that you once had the opportunity to borrow considerable amounts of money at historically low interest rates in the 2 and 3%, which we are likely not to see again. How can you keep and leverage that money borrowed at that amount without having to give it up, but still make some real estate moves? That's what we're going to talk about here today. And I'll kick it over to Dave to start us off. Welcome, Dave.
Rich, thanks for having me. Yeah, you bring up a really good point here. And the term that's been used is the unintentional landlord here. And this is for folks that, they, like you said, are considering move-in, but they never thought about the ability to maintain the home that they have now. This is something that we will share. Maybe you decide you're going to move and you're going to sell that house that has the 3 or 3.5 or 2% interest rate. You're going to sell it anyway. You're going to use all your equity and you're going to use that for a down payment on another house. The other option is to explore becoming a landlord and renting that house that you're vacating out and leveraging some of the potential cash flow on that property. And so everyone's scenario is going to be a little bit unique, but kind of the concept here is if you have a low mortgage, you have a fair amount of equity, you can rent out your house. And I'll just use some kind of round numbers. Maybe your total payment is $2,000, but you can rent your house out for $3,500 a month. So there's $1,500. Obviously, you got to keep some money set aside for some repairs and some maintenance and stuff. But then you could use that $1,500 to go towards your mortgage payment on a property that you're going to buy. Meaning, you might have a 6.5%, 7% interest rate. Your payment's going to be much higher, most likely, than what you have now, but you have some positive cash flow that you can use to apply it towards that new mortgage. Now, that holds true if you're not borrowing more money on the house that you're vacating. You also have the option, because if you're going to buy a new house, you have to have money for down payment. If you buy a new house and you're going to rent your house out, you are now buying a new home, most likely as an owner-occupied property, which means you don't have to put 20% down. You could put 3, 5, 10, 15% down, 20% down if you choose, if you have a fair amount of cash sitting around and if you want to use that cash. Or the other option is to put a line of credit, a home equity line of credit on your house before you decide to make this move. Home equity line of credits are variable interest rates. They're like having a credit card. You only owe on or only pay on what you owe. Maybe you open that up for, say, $100,000 and you can tap into that when you're ready if you need it. And you could use those monies for some down payment monies on a new property if that's the route you need to go. But now you need to consider that if your $1,500, for example, cash flow is now going to be shrunk based on whatever that payment is on that $100,000. So say your payment's $700 on that $100,000. Now you only have $800 positive cash flow to use towards your new purchase.
Yeah, and so this is a little more complicated strategy. You're starting to play Monopoly here. You're starting to become a landlord and kind of move your way up the property ladder. Although I think it does apply if you're moving down, if you are a retired couple, empty nesters who kind of got trapped in a bigger house because your interest rate was so good. Maybe you just rent out the bigger house and you buy down. The strategy works the same way. But the strategy, we always want to talk about who this is for, who this is ideally for. This is not a young person, first time buyer, really strapped for cash strategy. You have to have a little means behind you. The ideal way to pull this off, as Dave was saying, is to have a certain amount of down payment. It doesn't have to be 20%, but have the down payment in cash so that you're keeping your full previous loan at your low interest rate and then taking out the new loan at prevailing rates. This is also for someone whose income has increased or has considerable income, because you have to qualify from a debt to income ratio perspective for the new loan. right? So you have to have 2 loans now, and you're carrying 2 loans, and you have to be able to qualify for that. And there's other ways you can have non-occupant co-borrowers and things, to sign on to things. And we've done lots of other podcasts going deep into those subjects. But this is a strategy that's more for somebody of means that's looking to make a move and doesn't want to give up the opportunity of having been able to borrow at that low, interest rate, that low 3% rate. Turning it into a rental is an ideal way to do that.
Yeah, I think Rich, you bring up a really good point too. And part of that is if you're considering doing this, you don't have to jump in with both feet. There's options to say, hey, let's try this out without buying a new home right away. Let's rent out the property that we live in currently. We'll go rent somewhere or do an Airbnb, and maybe some adventure that you're going to go on and live in a different community, neighborhood, or location than you live now. Make it an adventure, rent your property out. Maybe it's a 6-month lease, 12-month lease, or a month-to-month, whatever you decide to do. And now you can see how comfortable are you managing a tenant and renting out your property. And simultaneously to that, as you talked about qualifying for the new home with debt to income ratio, is if you are renting your house out and now that shows on your tax returns that you had some rental income coming in, now you could use that rental income to offset your debt to income ratio on a new owner occupied purchase.
Yeah. And I think if you haven't hit some of these stages of life, what Dave just said and what I just said might sound like some outlandish sort of, fringe edge use case kind of things, but we actually see this all the time. And primarily, I see this with older people who've had grandkids. Soon as you have grandkids, everything in your life changes and you want to live where the grandkids live. So all the time I have clients whose kids have moved to other states. They have a grandkid and they'll go out and they'll rent an Airbnb for 1 month, 2 months, 3 months, 6 months as a sort of trial. Do I want to live in this state that I've never lived in before? How does it go living and being frequently involved in the life of my adult children, which is different than when they were younger and lived with you? And can we all make this work? Do we as a family want to live in this close proximity so I can be part of the grandkids' lives? I mean, I had literally 3 clients last year doing that exact scenario. And oftentimes they leave the primary residence vacant for that time rather than renting it out. But if they were considering this full strategy and they took advantage of what Dave was saying, they rented it out so that that rental income could apply to their debt to income ratio, then they're renting their home in California and they're going to go buy a new place in Seattle. Now they have that rental income. They've done their trial with the kids. They've decided they're going to move and they can pull the trigger on this. And they now have an income producing asset where they borrowed money, in the 2s and the 3s, which is just not something you could do today. And that positive income can offset the mortgage on the new place. I have parents who go and move to the place where their kids are going to be for college if they're retired parents. With older parents, there's a lot more people in retirement now when their kids are hitting these stages of life. And this is a great strategy for those types of people to not lose that, for some of us, once in a lifetime opportunity to borrow money at 2 to 3%.
Yeah, that's a really good point, Rich. And oftentimes too, is once you sell that house and you go live somewhere else, sometimes it's really unaffordable to come back. That house that you're vacating, based on Prop 13 has some locked in tax basis. There's some, real benefits of potentially for the right person for maintaining that home and becoming a landlord. And, now you're kind of double dipping once you buy a new house on principal reduction and maybe letting someone else make your mortgage payment on the home that you're vacating that becomes a rental.
Yeah. Well, I can't tell you the number of people too who have made that move for the kids and the grandkids. Well, these kids are in their 20s and 30s and they don't stay put. They move again. And then eventually, sometimes mom and dad decide they're not going to chase you all around the country and they want to bounce back to their original community. And so just having that home still there where you can, kick the renters out, within the bounds of the law, of course, and come back to the primary house, it gives you a lot of flexibility in terms of what you're doing.
Right. And I think the key to that is when you are vacating one home, and sometimes people just want to buy properties and you want to buy an investment property. The downside of just buying an investment property on its own is they have higher interest rates and they require much more down payment. So if you are in a situation where you don't mind or you have the tolerance to vacate the house that you're living in now, that your primary, go buy a new primary. Well, you could put as little as 3% down, 5%, 10, whatever's comfortable. Most people put more money down just to get to the payment to a comfort level. And if you have the cash, but if you can put less money down and you're still comfortable with the payment and you're leveraging some of the uh, positive cash flow from the house that you're vacating to offset your new payment, it's a great strategy. There's obviously pros and cons with becoming a landlord, and it doesn't have to be perpetual. Like I said, you could try it out. We're not tax preparers or, accountants, but there's some, benefits. People have heard about the capital gains exemption when you sell a house that was your primary residence. You do have some time to test this out and still get that capital gains exemption if you do it with the window of time.
Yeah. And where I see this strategy being a great one is for young people who maybe bought during the pandemic and they bought a smaller starter home and they've built a bunch of equity and now they've moved on in their careers. They have more income. They can maybe qualify for that new mortgage. Now, if they went out in the market right now at today's increased prices and today's increased interest rates, the amount of money they'd have to sink into a rental home to be break even or positive would be massive. However, they probably, hopefully, bought their first property with more money down. It was at a lower price and it's at a much lower interest rate. So when they bounce out of that property, they already are in a position to be positive monthly on that rental and then purchase their new home and use that money to offset the mortgage. So it is a strategy that is open to young people if they have built significant equity and had a decent jump in income from the time they purchased that primary residence until now. And I've had a lot of clients over the years that they've called me to sell the first house, and I've told them, hey, let's see if you can keep that house. And we've had, clients we've worked together on, Dave, see if you can keep that first house and buy another one without selling it. And those rentals have been chugging along forever, making great income and having somebody else pay off the mortgage for them, and have been a real benefit to them for their long-term wealth building, not to mention the flexibility that we talked about.
Yeah, and I think the key to that too, Rich, is if you do have a low interest rate, regardless of how much equity you've built, and you have a fair, we have good rental income in the areas that we work, Rich, the primary areas, rents are high, but part of that is if you have a low interest rate, the amount of your mortgage payment that goes towards principal is much higher than the amount that goes towards principal on a higher interest rate loan. So if you think about someone, renting your house out and they're making the payment, and maybe you're only bringing in cash flow, we'll say 700 to $1,000, but guess what? They might be you might be getting a principal reduction of $700 or $800 also. So that's not only are you bringing in positive cash flow or $700 or $800, you're reducing your principal by another seven. So now that becomes a $1,600 benefit to you. So that down the road, if you do decide to sell that property or whatever you want to do with it, or eventually maybe that mortgage gets paid off, but it's being paid off by somebody else.
Yes.
So it's a really good strategy. If I was to do this all over again, pre-kids, and I was willing to move more frequently, I think it's a great strategy to buy, live somewhere for a year or two, and then go buy up again. Go move somewhere else and keep that vacating property and take advantage of being able to be an owner occupied with putting as little money down as possible.
Yeah. So being that owner occupied, it gives you access to lower down payments, and in some cases, better interest rates. It also gives you that tax benefit, which again, we are not accountants. Check with your own accountant on your own personal tax situation. But in general, there is a $250,000 for single people selling and $500,000 for married people selling a primary residence tax exemption that you can take advantage of if you've lived there right now. Current rules, like what is it, two out of the last five or three out of the last five?
Yep, 2 out of the last 5. That's correct.
2 out of the last 5. So you can move out of your house and spend a couple of years as a landlord. And let's say you hate it. You wanted to try this thing out. You did it. You absolutely hate it. You don't want to answer the calls for a broken toilet. You don't want to deal with it. All right, no problem. Then you can still sell the residence, take the capital gains exemption, and roll that money into a principal reduction on your new residence and bring the mortgage down. No harm, no foul. Right? You're not locked in. You're not making a choice to be a landlord for the rest of your life. This really is a strategy you can try out and make a decision and have a reasonable window, a 2 to 3 year window to try it out and see if you like it. And I have, to be fair, had clients on both ends of that spectrum, clients of ours. I've got one who they've kept the rental and bought more and absolutely love it. And I had one who said, this is not for me. And about 2 years in, they sold the rental, but they still had their capital gains exemption, no problem. They rolled that money into their new home, and they're happy with that choice. So we're not saying the strategy's for everyone, but if it's for you, it is a great wealth building strategy and a great way to take advantage of borrowing money at 2 to 3%.
Right. And most folks that are doing that, at least for the bulk of the money that's borrowed on the home that they're vacating, it's a fixed rate. So that payment's not going up. It's not changing. If you have a line of credit, that might be variable. You might, be prepared for some variable debt on that. But the bulk of the money borrowed on that is a low fixed interest rate. So,
Correct.
over time, and you may, Rich, you bring up a good point is, you got some time to try this. But there's the other strategy is, you may do this for 7, 8, 9 years and decide, hey, I plan on moving back into that home at some point. So there's that option as well. And so,
Yeah.
maybe I'm going to move back into that home at some point, live there for a couple of years and then sell it. Because I kept it as a rental for beyond my capital gains exemption period. But now I want to reestablish that. So you can go live in there again, not accountants, not tax preparers, can't give a tax advice, but just in general, we could talk about some of the strategies that other clients use and that, people use to take advantage of, those benefits.
Yeah, exactly. And then now we can address another way to do this. If you have the income, the means to qualify for both mortgages, but you don't have enough money for the down payment, then there is another strategy that we kind of hinted at earlier in the podcast. This strategy is a little bit riskier. This is a cleaner move if you just have a new down payment and you move right over and you're only initiating one new loan on the new property. But there is another option available to you. Dave, why don't you talk them through that second option?
Yeah, that second option is a home equity line of credit. So if you're sitting there with your low interest rate first mortgage, you have a fair amount of equity, you can borrow, up to 80, 90% combined loan to value. So between your two loans of the current value of your home. Those are just general guidelines, not for everyone necessarily. But what you could do is if you're sitting on a house and you qualify for a home equity line of credit, which again is an adjustable rate, you can establish that and get that in place, and you only pay on what's outstanding. So let's just say you had a $300,000 mortgage and you want to go get a home equity line of credit for $100,000, and you're not going to use any of that money for the short term, very minimal cost. There might be an annual maintenance fee, $75, $100 for that, but that money's sitting there to use just like a credit card. Once you start using the money, you only pay on what you owe, and you could take, typically these have like a 5-year draw period. So if you're thinking, oh, maybe next year, that's the time that we might want to, go buy another house, don't wait. Put that home equity line of credit in place sooner than later. It's there. And so if something does come up and that, you can fulfill that strategy right away. And you also want to get that line of credit on that house while it's your owner occupied before maybe you rent it out and go live somewhere else for a little, for a trial period. You want to get that line of credit in place while it is still your owner occupied.
Yeah, and that money would sit there at minimal cost to you, but be available should something pop, should your home of choice come up, then you're ready to pull the trigger, and you only have to do a loan process on your new loan for the new property. Now, this strategy is not without its risk. This is a riskier strategy than the one before. So this strategy is for someone who, as I said, has the means to qualify for both loans, but just hasn't quite built up enough for a down payment. And by that, we're not talking about 20%. This is a new primary residence. You can go as low as 3%, but this gives you the ability to pull that down payment from the old home. However, HELOCs are going to be at an increased rate. So while you're doing this to take advantage of the ability to have borrowed money at the 2 to 3% range, this is now that you've pulled some out at this higher rate, that's going to create more of a blended rate effect on your original primary. So now it's not all at that 2 to 3% range. So to kind of talk them through that scenario, what a HELOC rate would be, what your blended rate would look like, how it adjusts what you've actually borrowed at on the primary if you go this route.
Yeah, so using that same scenario, Rich, if you owed about $300,000 on a, low 3% interest rate loan, and you went and got a home equity line of credit, rates based on credit score and qualification right now are in the, mid nines, which seems extremely high. But when you look at fair market interest rates to purchase a home, they're high sixes, maybe 7% range. So it's not, it's 2.5% higher than those other, than first rate mortgages in the market today. So that blended rate, if you borrow 100,000 at, say, we'll just say 10% range, and you have 300,000 at a 3% range, now you have 400,000 borrowed. And there's some math that says, okay, that's going to take your blended rate between those two mortgages somewhere probably in the 4% range, or, but another strategy to that is that money's available to put down, and that is adjustable rate. So the Feds just came out, and timing is appropriate on this, and they lowered interest rates. Those typically will bring those home equity line of credit rates down accordingly. But they're still relatively high. So another strategy that I like is having that home equity line of credit available. A lot of people think when you buy a new house, you just don't want to have mortgage insurance. I got to put 20% down. Well, I could tell you, if you're putting 5, 10, or 15% down and you still need to get mortgage insurance on the new purchase, I'm a big fan of that, because mortgage insurance, if you have decent credit and a decent debt to income ratio, is relatively inexpensive. And it's a fixed rate. It's a fixed cost that is going to be there until you're in a position that you can eliminate that mortgage insurance. And different, that's a whole separate podcast in terms of getting rid of mortgage insurance. But it's a great strategy, and you just build that into your cost and not have a higher amount on that home equity line of credit from your vacating home.
Yeah, and this is a way to take some risk off the table. Obviously, you're buying a second home. You've increased your financial exposure and risk. If you're doing it with just saved up money and a new original loan, like our first scenario, less risk. If you're then going to have to borrow some money against the original home at a higher rate via HELOC in that 9 or 10% range, now you've increased the risk, especially because that HELOC is variable. So it can't just go down. It can also go up and increase your costs over time. So you want to borrow as little as possible on that HELOC. So what Dave's talking about is just put less down. Yes, you take a little hit on your monthly mortgage insurance, but that's a fixed amount. You know what it's going to be. It's never going up. And you can, at some point when you have 20% or more equity, and get rid of it. And then you have borrowed less at that higher variable interest rate. And so you've minimized the risk there. So the idea being, if you're going to want to pull this trigger, do this, and you're going to use the HELOC method, you want to borrow as little as possible on that HELOC to do this particular move.
Right. And all these are just strategies that we've seen people use that, for the right person, can be a great strategy. And again, and I think which will be done. And, we might be piquing your interest if you're watching this podcast from wherever you're sitting, and this is maybe something you haven't thought about. There's tons of variables that go into doing this in terms of what the responsibilities are of being a landlord. And we'll have a separate podcast about that. And you could do some of your own research, and it could be scary. And I'm speaking to you as someone that, has rental properties and can share some experience, some advice. But these are things that have allowed me to, leverage real estate holdings by taking advantage of some of these strategies.
Yeah. And we like this strategy so much. The people I like this best for are our first time buyers, who then have been a few years in and they're going to buy up and buy the bigger house for their family, keeping that original home and converting it to a rental. It is one of my favorite strategies. Now, bear in mind, I make double if I sell your old house and then help you buy a new house. So when I tell you to do this, I'm taking a commission off the table. I'm taking half of the money off the table for me by telling you this is a great choice to think about for your long-term wealth building strategy, because it is that powerful to have that original home sitting there getting paid off by somebody else and making your rent each month. And because, and this is more of the higher level philosophical thought on this, but Dave's a dad, I'm a dad. Nothing's getting cheaper in this world right now. When I look down the pike at what it's going to cost me per year, for my kids, what it cost me for an entire 4-year college education for just 1 year for them. Homeownership is getting more and more out of reach. And think about homeownership projected in the future 20 years for my children. I have real concerns about whether they're going to be able to afford that. And so when I take this strategy now and I rent out my first house and I buy a bigger house for me and the kids, now 10, 11, 12 years down the road, a kid's going to college and maybe I didn't stuff their 529 plan as much as I wanted. Maybe I didn't have as much money. And we have a client who did this, he sold off the rental to pay for college. So he took the first house and he sold it and he took all that money and used it to pay for his kids' college. I have other people who took that first house and again, when it was time, they legally got rid of the renters and they turned it over to their kids when they got married. Here is a home. You can have home ownership. You can purchase this for me. I'm now in control of what I sell it to you for, what your payments will be, all of that. So I can make home ownership available to you. What an incredible gift and ability as a parent to transfer some of that generational wealth and provide opportunities that our kids just might not be able to pull off on their own. So this strategy has a lot of long-term flexibility and implications for you if you get the right advice and do it the right way.
Now, Rich, is that a gift to you or a gift to your kids? Because they're not coming back to live with you; they're coming back to live in one of your properties. So there is some selfish strategy there too, right?
Well, because my kids may watch this on YouTube someday, I'll say it's purely a gift to them. They're welcome back anytime, and I'd love to have them as little basement goblins forever. But
yeah.
but yeah, it is a gift for both families. But intergenerational living is really coming back to where you have two generations living in houses for longer and longer now because of affordability. This is another strategy to give people some more autonomy, let them stand on their own 2 feet. And the final thing I've seen people use this for in terms of family flexibility is when mom or dad get too old. And oftentimes when you're making this move, you love where you live. You just need a bigger house. So the second house you're buying might not be terribly far from the first house that you're keeping because you're staying in the same community. When you do that, this primary house, which is usually smaller and more reasonable and close by, becomes a great place. My next door neighbor actually did this, becomes a great place to put grandma and grandpa when they need to buy down or move down, or they're on a fixed income where they didn't save enough for their own retirement. You have a place to help them out with down the road. And once a lot of that equity has been paid off over a 10 or 20 year cycle, you can refinance that property and be in a really great position to help family with it. So it's not just a wealth building strategy. It's also a family flexibility strategy, which is one of the reasons I really love this particular one. If you do it right, if you take risk off the table, if you do it in the least risky way you possibly can.
Yeah. And one other point that we didn't mention, Rich, on top of that, and all your strategies, all your scenarios that you're talking about really make sense. But now you also are diversified with multiple assets. So, if you do have an investment property and you have your owner occupied, and maybe your scenario where grandma, grandpa, or someone, that investment property that you own doesn't accommodate them, or you need something else, you can do what's called a 1031 exchange on an investment property, where now you can sell that and go buy something different, or parlay that into, we won't get in too deep into the 1031 exchange requirements, but sometimes you could parlay that into 2 homes.
Yes.
So maybe you have 2 kids and, you have this investment property now, and down the road, they're fighting over who gets it. Well, you sell it and you go buy 2, and let them figure that out from there. So there's just, a multitude of ways to give you options down the road when you have diversified assets versus just your only single property, owner occupied property, that there's not much you can do with it because you have to have a place to live.
Yeah. I think if I was to wrap this one up, I would say from a 30,000 foot view, owning real property in the United States is unlikely to get more affordable ever, maybe, and certainly moving forward. So once you've secured real property at a certain price, at a certain interest rate for the debt, it is in your best interest, if you can, to keep what you've secured and add to that position rather than to keep selling to buy up, if you're a person who has the means to do it. And so if this has piqued your curiosity, if this is a strategy you're considering, then get on the phone, talk to me. We'll get Dave involved. You also want to talk to your accountant because it has some tax, implications as well. You need a whole team of people helping you put this strategy together. It is a little more complicated, but being willing to work through those complications, being willing to get some good advice from some good people can make a major change in your life 20, 30 years down the road. So we want to do this episode today. It's a little different than a lot of our content that is first-time buyer educational focus. This is, what's the next step? What's the next step after that first time buyer? And how do I take that? And how does that impact my life moving forward? And even though we have lost the opportunity to initiate new debt in the 2 to 3% range, it doesn't mean we can't leverage the debt we were already able to take out at the 2 to 3% range. This is just one way to do that. I hope you found it valuable. Again, you've been listening to Dave and I for a while now. If you made it to the end, we really appreciate your time and your commitment to your own financial education. Thanks for making it to the end with us. We'll see you on the next one. Dave, thanks as always for your time.
Appreciate it.
All right. See you next time, guys.